Picture this. You're standing in the middle of a giant big box store, surrounded by a literal mountain of products, and you just have to wonder, how on earth do they keep track of all this? But more importantly, how do they calculate their actual profit when millions of physical items are flying in and out the doors every single day? I mean, it's a logistical and financial puzzle that goes way, way beyond just reading a cash register.
So let's dive right into it. Welcome to The Explainer. Today we are going to unpack the exact financial tool that these massive retail giants use to solve this puzzle. It's called the merchandising income statement, and we're going to treat this document exactly like an onion, peeling it back layer by layer so we can see exactly how businesses transform a simple, everyday sale into true bottom-line profit.
Here is our roadmap for today. We'll start with the merchandising difference, look at the multi-step statement, calculate gross profit, dig into the cost of goods sold, track those inventory costs, and finally arrive at the bottom line.
All right, kicking things off with Section 1, the merchandising difference, comparing service companies to merchandisers.
Before we can even look at the numbers, we really have to understand the physical reality here. Think about a simple service company, like a mechanic. They have a very short, fast operating cycle, right? You perform a service, you receive cash. Boom, done. But a merchandising company, that is a whole different ballgame. They have to buy inventory, wait for it to be delivered, store it in the back, put it on a shelf, and then finally sell it. Having that physical inventory creates a much longer and far more complex operating cycle. When we're talking about merchandising companies, you should be thinking of familiar heavy hitters like REI, Walmart, or Amazon. They don't just provide services, they buy and sell physical goods. That's their primary source of revenue. The major hurdle they face, and the whole reason their accounting is so specific, is tracking that physical inventory. Every single t-shirt, camping tent, or flat screen TV is tied to a specific cost that absolutely must be accounted for.
Moving right along to Section 2, the multi-step statement, and how we handle those inventory costs. So this is the financial document specifically designed to handle that massive inventory hurdle. You see, a service business can often get away with a really simple single-step income statement. Total revenues minus total expenses equals net income. Easy, right? But merchandisers, they have to use a cascading multi-step process. The crucial takeaway here is that this statement calculates three main amounts in a very strict order so they can properly match their inventory costs with their sales. We step down from net sales to gross profit and finally all the way down to net income. Let's look at Section 3, calculating gross profit. This is the very top of that cascade. Think about the cash register for a second. The gross sales number, basically everything that got rung up, isn't actually what the company gets to keep. To find our net sales, we have to take total sales and subtract any items that physically came back as returns, as well as any sales discounts that were offered. Net sales represents the true revenue of the stuff that permanently went out the door. Now, once we have our net sales, we can finally find our gross profit. And this is simply the difference between what a company paid a supplier for a product and what it sells that same product for to you, the customer. You probably know this colloquially as the markup. It's incredibly important because it tells us exactly how much money the core business model is making before they even start paying for things like lights, rent, or employees' salaries. Which brings us to Section 4, cost of goods sold, easily the most significant cost in retail. To find that gross profit we were just talking about, we have to subtract a very specific number. Cost of goods sold, or COGS, is literally the single biggest expense a merchandiser will ever incur. It's the total historical cost of the merchandise that actually went out the door. And the accounting theory here, the matching principle, is absolutely crucial. Imagine a local cafe spends cash to buy a giant bag of raw coffee beans. Well, that money spent isn't actually an expense yet. It's an asset, just sitting in the back room. It only officially becomes a cost of goods sold expense when that specific coffee bean is brewed and sold to a customer for revenue. You have to match the cost to the sale. It helps to visualize this as a physical journey. You start with your beginning inventory, the stuff already sitting on the shelves. Then you add the cost of goods purchased, the new boxes being unloaded off the delivery truck. Together, this creates your total cost of goods available for sale. From there, those goods only have two possible destinies. Either they were sold to a customer, which moves them into cost of goods sold, or they're still sitting right there on the shelf, which makes them your ending inventory. Section 5, tracking inventory costs. We'll look at perpetual versus periodic systems. So how exactly does a company with millions of products keep track of what's sold and what's still on the shelf?
Well, they generally use one of two systems. The perpetual system is what you're probably used to seeing. It continuously updates detailed records in real time. Every single time a barcode is scanned at the register, inventory is decreased in the system and cost of goods sold is immediately recognized. The alternative is the traditional periodic system. This doesn't keep detailed real-time records at all. Instead, the company literally stops what they're doing and counts all the physical inventory at the end of the accounting period just to figure out what's missing and therefore what must have been sold.
Now, within those systems, how do you actually value items that were bought at different prices over time? Well, first in, first out, or FIFO, assumes the cost of the oldest inventory on the shelves is matched against the very first unit sold, kind of like grabbing the oldest milk in a grocery store cooler. On the flip side, weighted average cost just blends everything together into a single average unit cost. It takes the total cost of all units and divides by the quantity on hand to create a smooth, blended cost applied whenever a sale happens. And here's the wild part. This isn't just dry theory. During periods of high inflation, choosing FIFO instead of weighted average will drastically change the actual profit reported to investors.
Finally, we reach Section 6, the bottom line, focusing on operational expenses. We have practically peeled this entire onion. We found our net sales, we subtracted our cost of goods sold, and we arrived at our gross profit. Now for the final equation. Gross profit minus operating expenses equals net income. This right here is the true profit that is actually left over for the business. So what exactly are these operating expenses? Honestly, they're everything else required to just keep the doors open. They typically fall into two buckets. First, you have selling expenses, the effort to market and move the product. This is your advertising, promotions, or the wages of the salespeople out on the floor. Then you have administrative expenses, which relate to general management. Think human resources, the accounting department running these exact numbers, or the company president's office. Once all of these are paid out, whatever remains is your true net income. So, we've gone from a chaotic mountain of physical products to a single bottom line number. It is an incredibly structured, logical process when you break it down. And I want to leave you with this thought today. Next time you're out buying a cup of coffee or a new pair of shoes, ask yourself, what exactly just happened in the background? Did your purchase just trigger a real-time perpetual update, or are they going to have to count it at the end of the month? And most importantly, did you just trigger a FIFO or a weighted average cost calculation? The physical world and the accounting world are linked a lot closer than you might think. Thanks for joining me on this explainer, and keep asking those questions.